everyone, this is Prapti from Naukri Learning. Naukri Learning is a one-stop solution for all the upskilling needs of a working professional. I welcome all of you today to our expert webinar session on building a career in investment banking and capital markets. In this session, we have Mr. Harish Thakkar with us. Harish Thakkar is the head of faculty at Intermediaries Learning. He has over 18 years of experience in investment banking operations with expertise in global and Indian capital markets, products and operations lifecycle. He is an advanced CISI certified trainer. After setting up the training academies for JP Morgan, Nomura and Stockholding Corporation, he became the lead trainer for the BFSI content development at NIS Sparta. Managing 300 plus FTEs in investment research and IB operations has given him an in-depth domain understanding of capital markets. Welcome Harish to our webinar session. Thank you so much for doing this. I hope we make good use of your time here. Over to you.
Thank you very much, Prapti. Thank you very much, Prapti. Pleasure really, coming down and doing this session. And I'm equally hoping that this is a value add for all today. And more than happy to answer questions. Talk about the agenda today. While the objective is going to be to talk about financial markets, capital markets, or investment banking, but the idea is to really start off talking about the financial landscape as such, and then we probably get into specifics of a financial market or how an investment bank works, and then get into some of the examples and so on. But happy to answer questions, happy to make it very interactive. So I think let's just begin. Let me start off with some of my experience, and having interacted with a lot of people in the last 3 or 4 years, particularly on the career side, and people with 0 to 3, 4 years of experience, and asking them a question. A lot of times I hear this, that people want to make a career in core finance or finance as such, and that frankly does not tell anything in terms of what the individual really wants to do. And my next question to always to these people is, finance is an ocean. There are so many things that happen. Is there anything specific that somebody has in mind, or is there anything specific that they like to make a career in? So I think there's what it kind of tells me is that clearly there is a scope for building awareness in terms of what are the options, or what are the various functions, businesses within the financial landscape as such. And I think maybe it may be a good idea to kind of start off also here with some sort of a poll here. So I'm going to put up a particular question here, and it would be great to have some responses from the attendees today. Kind of tell us in terms of what the attendees think of as far as their career is concerned. So here's the poll. Maybe you can take 10-15 seconds to kind of answer that. All right, I see some responses. Yeah. Yeah, so I think I've got about 83% of the people voting as of now. Let's just maybe give some more time to the 17% if they'd like to respond, or probably they're still thinking. Right. All right, so I think, okay, still some changes happening. Yeah, 89%. Let's just wait. Yeah. Okay, so let me just close the poll now, and what I see is 50% of the people have, and let me just share the responses here. So as you can see, we have about half of the people clearly indicating that they would probably want to look at investment banking as the career option. And financial services is second at 31%, capital markets at 19%. Surprisingly, asset management is at 0%, and I'm frankly a little surprised, but maybe as we go along, and if probably I were to take this poll again at the end of the session, I'm sure some people will move to asset management as well. But anyway, let's get on with the session now. And so let's just begin with understanding the financial landscape as such. So it's very important to kind of start off on a very broad note, take a 50,000 feet view in terms of the financial landscape and, what this is all about. So to kind of put that into perspective, the financial system is basically, something that will have a lot of participants, markets, different types of products and services being offered. And that really comprises. But if you were to understand the entire system, it's very simple to understand in terms of the fact that the entire system can be divided into two set of people or two set of participants. One would be people who have the funds and would like to invest or who can give away the funds for obviously better returns and so on. And the other side is somebody who needs funds. So I can probably put it this way, that either you have somebody who wants funds or somebody who has the funds. Call it funds, call it money, call it capital. It's the same thing. I think it's only about maybe the duration or how long somebody wants the money, and you probably not call it money but call it capital. And if you look at the two boxes of lenders and borrowers, you see the same set of people, or you have households, businesses, because at any point in time we also invest because of some of the surplus funds that we have, and also at some point in time we need money or requirements and we kind of borrow. So both the set of people kind of fall into both the categories. And I think we can take a very simple example that you have a surplus fund and you might want to go to the bank and take out an FD. So you've really invested the money, you had money and you kind of invested it. And at the same time, you also take a home loan from the same bank or other bank, and there you become a borrower as well. So it really depends on the need, the time horizon, and all of those things which kind of put you into both these categories. But what is important to understand here is that how do you get these two people to talk to each other or meet? And this is where you have the financial intermediaries coming in. So somebody needs to get the person who has the money to meet the person who needs the money, and that's where financial intermediaries come in. And classic example of that is a bank. A bank kind of accepts deposits and also gives away loans. So a good example of a financial intermediary. Now, it's not always about lending, borrowing. It's also about buying, selling, or trading, which means it calls for a scope to create a market. Now, typically, if you look at any market, or rather, if you say a dictionary meaning of a market is a place where a buyer and seller will come together. So, financial market again would be a place where you will have people who have the money or want to invest in certain instruments, and at the same time people who need money would kind of reach out to the market. So that's really a 50,000 feet view in terms of the financial system. And the financial system obviously plays a very important role because that clearly mobilizes the funds from one party to the other. Somebody who has the money, if he's just going to keep the money, that's not going to grow in any way. So clearly there is a scope for investments there and make more money out of the same money. At the same time, businesses need money to be able to expand, to be able to set up things and so on. And all of this activity will ultimately contribute to the national growth. So that's, I think, pretty much self-explanatory. And I'll come back to the stock market or the bond market as we go along in the course of the discussion now. As I had said earlier, financial market is a place where you will have these financial securities being traded. And let's say, take an example that if a company wants to mobilize funds or need funds, and this is clearly a huge amount, could be billions of dollars or even billions, then they need the investors to kind of chip in their bit, and the best way is to kind of go through the route of financial markets. It's really about why do you need a market? It's because you need to be able to reach out through a common platform, and I think that's the best way to explain a market. It's a platform where buyers and sellers can come together and trade. So financial instruments traded could be short term, could be long term, is how I would define a particular market. Now, it's very important at this point to kind of understand the functions of a financial market. Why? Because when it comes to trading, if somebody wants to buy and somebody wants to sell, and I'm keeping it very, very generic at this point, just to kind of make it very simple, is that if somebody were to buy something or somebody were to sell something, the question comes, at what price? Now, obviously the seller would want a higher price and the buyer would want a lower price. But it's this demand supply, the point of intersection where demand meets the supply, and that's the right price. So financial markets kind of help price discovery. Now the word is used as discovery because buyers will put their quotes or intent of what price they would want to buy, and the sellers would do the same, and there would be a point of negotiation, and there would be a point of price where the buyer is comfortable and the seller is also comfortable, and that leads to the price, and price is really can be defined as the value of the product or the the value that the buyer is ready to kind of pay or the seller is ready to sell at. So financial markets kind of help price discovery. The other bit is liquidity. Liquidity, in the simplest of way to explain, is to kind of the ease with which you can trade or sell or buy. If there are all buyers in a particular market, clearly there's not going to be any trade. If there are all sellers, then again there's no trade. So financial markets help bring the buyers and sellers together, which ensure that there is a trade. Is liquidity. Now, with a lot of people coming in and coming to a common platform, clearly the intermediary, the need for intermediary kind of is done away with, which means that the transaction cost is going to be less. Today, if you were to buy through a broker, and I don't necessarily mean the stock market brokers, but could be anybody, be it real estate brokers or anybody else. Clearly, there is an element of commission. There is an element of brokerage that comes along with this, which means that's nothing but a transaction cost. If I buy a particular product for 100 and I'm paying a rupee, then my cost is 101, and the seller has also sold it for 100 but ends up paying 1 rupee as again a brokerage, which means the net to him is 99. So clearly I paid 101 and the seller got 99. So there's these 2 rupees, which is basically a transaction cost. Now financial markets, because there's a common platform, the intermediaries, while the element of intermediary will still remain because there is a licensed member or a broker who's doing it, but with enough liquidity in the system, the transaction cost definitely comes down. Any questions at this particular point in time? You may please put in the chat. Happy to kind of answer, but otherwise we can keep it towards the end when we can do a Q&A session. Moving on, so some of the top financial centers, some of the major financial centers listed out there. Now, again, the financial markets would be a good time and a good opportunity to kind of talk about two different types of markets, and that I intend to further utilize this when we talk about investment banking particularly and the capital markets. So primary market is the first time issuance of any particular shares or securities, and all the subsequent trades or change of hands that may occur will be termed as secondary markets. So the first transaction between, let's say, a company and an investor would be a primary market, and when the investor then sells it to another investor and so on and so on, all the other subsequent transactions will be secondary market. Now, if I were to just use this particular slide to explain investment banking and capital markets or financial market operations, then again I would say that investment banking would fall on something on the primary market side of it, and secondary market would fall in the trading business of any investment bank would fall in the secondary market, and definitely we spend more time talking about this as we go along. So capital markets is again a place where long-term securities are traded. The word capital suggests the long-term nature of the relationship, or when investors buy, sell, if the relationship or the idea is to borrow or buy or sell for a longer period of time, that's more like a capital. So it's not really a short-term requirement which corporates or individuals or governments may have, but it's basically a longer term in nature, which is why, as you see, the securities have a maturity of more than 1 year. When I say maturity, it basically means the terms of the contract or the time when the money is paid back is called as a maturity, or the period rather, and that's necessarily more than 1 year. Again, who can issue equities or bonds? Well, companies can issue equities, governments, public sectors also take part in issuance of equities or bonds, and the entire secondary market, or rather the trading, would take place in the designated stock exchanges, or place where these securities would be traded. So again, same thing in terms of somebody who has the surplus funds, clearly wants to make more money on the money that they have, wants to invest for gains and profits, would look to buy a security or a share or a stock with the objective to make more money. On the other hand, somebody who needs funds is ready to either borrow the money or is willing to share the ownership of the particular company or corporate. So that's where again the word comes in share. So here is a set of people who need money, and since they are looking to get funds by selling the securities, so you see the term there as a sell side. Buy side on the other side is somebody who has the money is buying the securities. Just to kind of put that into a very simple manner. Again, participants, a lot of them really, and most of them, as you can see, are intermediaries. So let's talk about issuers to start off with, and investors, because these are the ultimate uh, borrowers or the lenders. So issuer is the one who needs money and is willing to kind of sell the securities. On the other side, the investors are the ones who have the money or have the capital and would want to invest. The rest of the participants are intermediaries who perform different roles. A lead manager would be, nominated or you know, appointed by an issuer to take care of a particular issue or ensure that the money comes in and he mops up the funds from the investors. Then there are broker dealers or custodians or registrars, depository participants, depositories, clearing agents. These are all on the clearing and settlement side of it or secondary market side of it. So you will have people who keep your securities, those will be depositories. You operate through their agents called as depository participants. Once you want to trade, you'll go to a broker and or dealers and do the trading. Once the trade is done, somebody is required to do the clearing and settlement. That's where the clearing agents will come in. The custodians are the ones who actually do the safekeeping of securities and manage the entire post trading activities for their clients. And registrars are the ones who maintain the register or the list of their investors or the shareholders. So a lot of participants and taking part in the entire financial market operations. Let's just understand the process really. We've seen the participants. Let's just try and understand how the entire trading will take place in a secondary market scenario. So an exchange, again, as I said, is a platform where buyers and sellers will come together. But again, how will a buyer identify a seller? And it's not that everybody can walk up to a stock exchange or log into a stock exchange system and trade. So there are licensed members who are authorized to trade on behalf of the in the stock exchange. So that's what you would call as brokers. And the investors or people who want to buy or sell need to register themselves with the brokers and trade on the stock exchange. I think one other thing that we probably need to mention here is also that the companies who have by way of primary market got you to invest your funds and sold you securities need to provide you with a particular place where you can sell the securities, because you can't go back to a company and say, I want my money back, because the company if you are from the commerce background, if you've read the Companies Act, a company is a going concern. It has a perpetual succession. So the investors or the shareholders will not get their money back until and unless, of course, the company liquidates and there is something to kind of share. But so how does an investor who's invested money and bought the shares of a company kind of gets out of it if he or she needs money? So clearly there needs to be a market where the investor can go and sell the shares. Hence the companies approach the stock exchanges, pay a particular fee, an annual fee, and get the stock exchanges to list their shares. In other words, get their shares to trade. So you have the companies approaching the stock exchanges, where the stock exchanges allow trading in these securities, and then the brokers are the licensed members through which the buyers and sellers will trade. Similarly, if we talk about, let's say, the other type of security, which is a debt or a bond, bonds are necessarily borrowings, really. These are securities which the objective is to borrow for a particular period and redeem the money or redeem the securities and pay back the investors. So while there is, while bonds are also traded on the exchanges, but most of the bonds are traded over the counter, which means it's not on the stock exchanges, but here the investors, and these are institutions, these are large investors, these are corporates, so they rather talk to each other directly. So there's no, there will be of course intermediaries who will facilitate the transaction, but not necessarily there will be an exchange for it. While of course exchanges do list bonds and there is a secondary market available for bonds as well, but largely it's over the counter. Now, if somebody has taken a loan, let's say $1 million or a bond worth $1 million, how can there be a trade? Because it's necessarily in a simple terms a loan. So how can there be a trade? But of course, the interest rates change. So suppose if I have borrowed funds at 7% and the interest rates in the market are the RBI cuts the interest rates, and let's say after 6 months it's 6%. So the bond that I'm holding is at 7%, which clearly is an attractive investment opportunity, given that the now interest rates are 6%, which means that there will be a demand for this bonds, and the price hence will go up. So that's where the resale value comes in, or that's where the opportunity to trade in a bond comes in. Secondly, if let's say a company is doing well, but and comes up with a bond issue, raises money, gets money from people, but after a few years is not really doing well, clearly investors are going to get worried about it, that their money is no longer safe, which again means that the resale value will go down, and they might want to sell these bonds to somebody else for a lesser price. So all of this is nothing but supply and demand for bonds, and which is why the need again for a market, the need again for the investors to come together and trade. All right, so so this is some of the statistics, information in terms of the kind of market that we are talking about. Huge volumes, as you can see. It's 850 crores in the capital markets, or overall derivatives, those more than even a lakh crores and so on. So clearly a very, very big market. Now let's focus on the investment banking. So what we've done is look at the secondary market, and now I'm going to step back to get back to the investment banking side of it. And again, since 50% of the people express their interest, I think this is where the interest will come in further. So an investment bank again is, in very, very simple terms, is somebody who will help organizations, governments to raise capital. The idea is investment banking works for people who need money or capital. So they're the ones who will raise capital, help the organization raise capital. They, on the other side, they will reach out to people who have the money and get the deal going. Let me again, let me get some more perspective as we go along and define that better. Here are some logos, some of the best known names in the industry globally as far as investment banks are concerned. Okay, I'm sure some of you might be aspiring to work for these banks, I'm sure, given again that 50% of the people exhibited or expressed their interest in investment banks. So maybe these are the logos you can look forward to work with. So as I said earlier, the investment bank is somebody who will help organizations, firms, governments, corporates raise capital. They will be, reaching out to people who have the funds. So as I had started off my conversation, this is about people who have the money, and this is about people who need the money, or capital rather, in this particular context. So people who have the capital as in long-term, huge funds to kind of invest in, typically money managers, hedge funds, pension funds, insurance companies, mutual funds, and even some of the high net worth individuals. They have the funds. Now, if we probably spend about a minute more on this, if you look at these players like a pension fund or an insurance company or a mutual fund, uh, where is this money coming in from? Insurance. Again, you and I as individuals pay premiums for the life insurance or the general insurance contracts. Where does this money go? This obviously needs to be invested. The insurance companies invest to make money on your money, to be able to give you money when you need it, or with additional returns. Mutual funds, again, same thing. So common pool of resources will come together, put in their money and give it to the fund manager who invests on their behalf. So again, if you look at it, and I'll reiterate again once more that even if you look at the insurance funds or the mutual funds or pension funds, at the end of it, there is an individual investor who's putting their money, who has their savings and is investing. On the other side, you have people again who are capital users. So this could be corporations, it could be governments as well, and investment banks uh, uh, raise capital or raise money on their behalf. Again, if you look at it, uh, people who invest again are investors who put in their money. So if you look at the have capital or the need capital, the ultimate borrower is not really, or the ultimate investor is not really knowing the other party. So you have an investor who gives money to an insurance company or a mutual fund. They invest in and through the investment banks. And again, you have corporations on the other side who take your money and do their businesses. So investment banks, again, as I said earlier, work for the buy side and the sell side firms. Rather, they are on the sell side because they sell the securities, approach the buy side to get them to invest. Now, the route could be again a private equity. Now, if I'm looking at raising, let's say, $100 million, do I necessarily have to reach out to the public? The answer may not be yes. I probably need to reach out to a set of individuals and get them to invest. So whether it is a public offering or a private placement or a private equity, we'll talk about it as we go along. But the investment banks are on the sell side, and they get the buy side guys to invest, and that's how investment banks work. And let's just look at the various functions within an investment bank, and this largely is on the primary market and then culminating into a secondary market. So as I had said earlier, an investment bank will help organizations raise capital. So that's where you see the advising on mergers, acquisition, or fundraising, comes up. When I say advisory, so let's say an individual, a firm wants to raise 100 million. So what is the best way to kind of do that? Should they raise all through debt as a borrowing, or should they give it away as equity. That's a strategy. That's again something that the investment banks can advise on. Again, should there be a private placement or a private route to reach out to a set of individuals, or go to the public and come up with an initial public offering? So that's where the investment banking front office guys will do this bit. Once the deal is done, once the securities are issued and the investments have been done, comes the bit about secondary market. So again, here's where the investment bank again play a role, playing the role of a market maker. Let's just again talk about the market. The need for getting the buyer and the seller to come together and do the trade. So as the word itself is suggesting, investment banks make markets. So they're the ones who kind of bring the buyers and the sellers. So they, irrespective whether they have a seller, ready to sell, they will play the role of a seller for a buyer, and they will play the role of a buyer for a seller. So they're the ones who act as a buyer for the seller and vice versa. So that's what market making is all about. Now, once the trade is done, so the trade is agreed upon, the trade is negotiated and agreed upon, comes the rest of the entire post-trading activities of clearing, settlement, treasury management, funds moving in from the buyer to the seller through the investment banks, the securities moving in from the seller to the buyer through the intermediaries. And if you recall, we had spoken about clearing agents, depositories, custodians, and so on. So there are a lot of intermediaries who play a part. Essentially, it's the middle office guys or the back office guys in an investment banks who will do the end-to-end of operations of a particular trade. So a trade takes place, but the entire post-trading activities right up to the final accounting entry or the financial reporting is done by the middle office or the back office people. What do the traders do? Now again, traders can play two different set of roles really. One is being a broker, being an intermediary. I can actually trade on behalf of my clients and just do broking as such. So all I'm doing is acting as a middleman, an intermediary, and facilitate the deal. So that we will call it as an agency trade as such. But if I were to buy the securities as a firm for my own, in my own books with the objective of investing or trading, then that would be termed as a proprietary trading. So if I were to facilitate a deal or buy or sell on behalf of a client, then that would be an agency trade. But if I were to do it in my own books, put in my own money with the objective of making money or making profits, then that would be a proprietary trading. Let's talk about the other aspect of the investment banks. And this is a term we hear a lot, companies acquiring other companies or two companies coming in together and forming a single new company or a giant really. So a lot of examples there, and we'll talk about more as we go along, but there you see some of them there, some examples of mergers and acquisitions there. Question is, how does an M&A really work, or a transaction really is done? Well, there goes a lot of hard work into it. First and foremost is that if, let's say, a company wants to acquire the other company, and I'm going to take an example here, which of course is coming up in the subsequent slides, but might as well introduce it here. So all of you must have heard about Facebook acquiring WhatsApp. So two different companies, but Facebook interested in buying WhatsApp, and the deal was for about $19 billion. The question is, how did one come across this number, 19 billion? Clearly, there is a lot of hard work behind it in terms of valuing the company. So how do you really value a company? And that's the core of investment banking, really. So typically, a company is valued based on its enterprise value or its revenues, business, growth prospects, market share, projects in hand, or future outlook. Based on all of these parameters, investment banks value a company. There are various models, financial models are applied, ratios are calculated, and all of this really goes into valuing a particular company. And to be able to come to the right price is what investment banks do, and that's what they advise on. So whether $19 billion is the right amount, or is it an overpriced deal, or is it a good value buy, those are debatable things. But clearly, because Facebook sees a value in it, maybe if you were to just look at the existing financials of WhatsApp, maybe 19 billion would not be justified. But there is a thought in terms of maybe synergies between the two companies, and that clearly or was one of the very big parameters to going for such a valuation and acquire the company. So how much are you willing to pay? Well, there goes a lot of hard work, a lot of effort in terms of getting to the right kind of price. A very systematic way of doing it. There are valuation models. There are financial statement analysis that needs to be done, and then thereby arrive at a particular number or a price. Once again, if the objective is to raise money not through the private individuals but through an IPO, and I again would want to relate it to my earlier talk about valuing a particular company, or if I say that I were to raise, let's say, $100 million, and here again I will take the example of Facebook. So Facebook has had needs for capital for further expansion or whatever reason, and they want to go to the public. So Facebook decides to go to public and offer shares of their company at a particular price, and I'll come up with those details as we go along. But the idea is that a private company like Facebook wants to give away their shares or sell their shares to the general public at a particular price. Now again, what that price should be goes back to our earlier slide where we talked about the valuation of a company and what is the right kind of a price. Again, if I can give you an example, TCS is a very good example. A great company comes up with a public offer in 2002, if I'm not wrong, and gives away a share for 950 rupees. For the individuals, private individuals, it was 750 or something like that. So a 1 rupee share is valued at 750 rupees. Can you imagine if somebody were to tell you, hey, there's this share of 1 rupee, would you be willing to pay 750 rupees for it? I'm sure a lot of people will say no to that. But when you look at the company, when you look at the prospects, when you look at how great the company is, then you clearly see an opportunity that, of course, this 750 will become multifold, and that has happened in the last decade or so. So valuation again, is key again. Let's just move on to the process of how does a company really go about issuing the shares. So one, of course, is not everybody can take the IPO route and overnight decide to sell shares to the general public. So there is necessarily an approval process through the register, through the regulators of a particular company or country. So you'll have a SEBI in India who would monitor the capital raising IPOs. So there's this norms and rules around that. Once you have the required approvals in place, the company would want to appoint the lead managers. If you recall, we did talk about a lead manager when we were talking to participants. And then the registration of documents. So the document which the prospectus, which basically is talking about the issue, the business, the financial statements, the risk involved as well, needs to be filed with the regulators, and the regulator ensures that there's no misrepresentation, there is factual information provided there, there is in no way the document is misleading the investors. So the regulators' objective is that the investors are not fraudulently got into doing these issues if the issue does not really have merit. And then finally, of course, we talked about it earlier as well, is the determination of the price. So Facebook decides that the price should be $38, or TCS decides it should be 750 rupees. It's again a valuation bit. And finally, once the people or investors express their interest, apply for these shares, the allocation of the shares are done. There is a mechanism to do that as well, but unfortunately, we will not be able to talking about it today. So some of the figures again in terms of the kind of money that organizations, firms have raised. Alibaba is a latest example, raised about $21.8 billion. It was one of the highest IPOs in terms of the money that was raised. So clearly a huge number there. Facebook at number 3 there, and some of the others as listed. So as I had mentioned, and I'm not going to spend more time on it, so Facebook came up with an IPO. This was in 2012. This sold about $460 million at a price of about $38 per share, thereby making it a $16 billion issue. Again, some of the other deals that have been done in 2015, the very well-known Flipkart there on the top, $700 million funded by some firms listed there. And finally, you have a merger that we recently read in the newspapers. So you have the HDFC Life and Max Life coming together. So that's a merger that has just been okayed, and they've come together to form an entity. So those are some of the details of an M&A. Maybe I think I'll stop. I think I do have a question here, if I can just answer that. Yes, so there is a question there which says, what is the difference between an IPO and an FPO? An IPO is an initial public offering, and an FPO is a follow-on public offer. And as the words suggest here, so when a company comes up with a public offer the first time around, it's an initial public offering. So a company, let's say, chooses to raise about 5,000 crores, sells shares, does business for some years, and then after some years decides to further come up with another issue because probably they need more capital to be able to expand or whatever it is, come again with yet another public offering, and that would be a follow-on public offer. I hope that answers your question. Happy to take any questions at this point. From a presentation perspective, I have done my bit, but I think let's just spend the next some time, 15-20 minutes maybe, or whatever, depending on the number of questions we get, answering those questions. So I'm happy to answer any questions if you have any. Okay, I have another one. Would the follow-on result in a fall in the price of the present shares? Okay, so there is no straight answer to this question, but clearly when the existing shares, let's say, are listed at, let's say, 500 rupees, and if the company is coming out with a further issue, they need to keep it lesser than, of course, 500 to be able to attract investors. Because if my shares are trading at 500 bucks, can I really ask for 550 or 600 rupees from the public? The answer would be no, which means that there won't be a demand for that. And hence imperative that the price is kept very, very competitive to be able to generate interest in the issue. Now, post the issue, will there be a result? Will that result into fall in price? Well, really depends in terms of what's been the price of the issue vis-a-vis the market price, and whether the issue has resulted into the existing stock price rallying to that extent or so on, or is there an opportunity for an individual to buy shares from the new public offer and at the same time sell the existing shares in the current market. So really depends on the two prices. Yes, definitely there will be an impact because the prices are kind of kept a little buoyant while the issue is on, just to be able to retain that interest in the issue. I have another question which says, what is the difference between investment banking, research, and financial services? Oh, actually, a lot. Really, two different things. Financial services are a lot of a set of services ranging from not just the primary market issuance of securities and managing those offerings, but also secondary market trading, clearing, settlement, custodial services. So that's a very, very larger aspect of financial markets. A lot of services come under that. Whereas investment banking research is more about the financial statement analysis, determining the exact price, valuing a particular company. So that's more of a research on whether the company is is a good candidate for an M&A, or is it a good is it worth the valuation that the company is expecting, or the research is also about what should be the price that should be determined for a particular offering and so on. How do I get into IB front office as an MBA fresher? That's the next question that I have. Well, of course, the MBA definitely has helped you create a foundation in terms of finance. But if you want to get into IB front office, then clearly a lot more a specialization is required in terms of understanding the roles of what a front office trader does, understand risk management, understand how trading happens, learn the nuances of trading, learn the regulations or the risk management mandated by the exchanges. So I think all of these, once you have the required knowledge and the skills, that's how you make a career. What is the basic difference between primary market and capital market? Primary market is the first issuance of the security. Capital market is a secondary market, and the word capital suggests that it is a market where longer term securities are traded. So if I were to give the difference, primary market is the first time issuance of a particular security, and if that same security, and if it's a long term security, gets traded, then that will be traded on the capital market. So yes, let me talk again about financial services. I think I did talk about financial services in the context of the intermediaries, playing the part of a broker, a clearing agent, a depository, and the other financial services could be asset management or a mutual fund, operations where the funds are collected from the investors. A common pool is created with a common objective and risk-taking ability, and that is entrusted. The funds are entrusted to a particular fund manager who will then invest on behalf of the investors. Yeah, and there's another question. So if you want to work in financial services, well, definitely, I think there's tremendous scope in financial services today. There is a lot of change that is happening in financial markets. Globally, there are banks, investment banks who trade heavily on a day-to-day basis in financial markets. So clearly, there is a lot of opportunity to make a career in financial services, not just with the domestic firms or Indian firms, but also with the global firms. So clearly there is a very, very lucrative and satisfying career opportunity in financial services. But of course, the graduation or post-grad degrees will have to be further complemented with a specialized knowledge or industry relevant knowledge. So if somebody were to work for a JP Morgan or a Barclays or a wealth management firm in India, you need to know what they do on a day-to-day basis. So you need to learn those functions or businesses or processes that they do, and then it gets very difficult, very easy rather, to kind of get into these firms. Another question I have is, what are the parameters will be considered for purchasing of a company for a certain price? Yes, so a lot of parameters. So if, and let me give you a simple example. If tomorrow a company wants to buy another company, then definitely they would want to know the existing profits, the market share, the sales, the cost, the margins, the profit margins, the existing structure of the capital. Is it a lot of debt? Is it a lot of equity? Or a mix of both? And if so, then in what proportion? What are the synergies? And I think this is a very, very important point, and that when a firm decides to buy another company or a firm, it's very important to understand both the business models and to identify if there are synergies between the two companies. And if there are, then it definitely becomes a very important parameter for an acquisition. So those are some of the parameters. What if you have just the value? How do you check on a value of a company if you just have the past 3-4 years of maybe balance sheet results and so on? Yes, I understand where you're coming from. I think past results definitely will give you a good idea in terms of the performance of the company, how the company has kind of come along this way. But I think one thing that again should be a good indicator is how has been the management strategy in the past. What are the business strategies, or what are the businesses that the management is into, and thereby the prospects strategies or businesses in future. And that's something that one has to look at. So it's, yes, the past performance is very, very important, but to be able to understand and gauge the business prospects or the future outlook of that particular company will be very, very important and a deciding factor in whether to invest or not. Is there a specific course in financial services? Well, yes, definitely there is, and I think you can get in touch with the Naukri Learning team. They will be happy to help you and provide you with more details on this. Which module in NISM is best for MBA students? Well, NISM gives a lot of modules, and it's very difficult to kind of kind of attach it to a particular MBA degree and say that which one is the best. So I think it's a very vague question for me to be able to answer, unless you're really looking at a particular career opportunity first. So I think it's first you have to really think of where is it that you would want to make your career, in which particular area, and then kind of choose that one. Is there an NISM course in the first place to be able to help you with that? If not, then can you look at any other courses? So I think you have to look at the list of NISM courses, and if there's a course that can help you, great. If there isn't, then maybe you need to look elsewhere. We want a practical training. Can you help? Well, short answer, yes, I can help, but maybe not at this point and not directly. It would be great if you can, get in touch with Naukri Learning people, and I'm sure they will be able to guide you to this. Okay, so I think I've answered the questions. Right. So I think if there are no questions, maybe we can end my talk here. And thank you very, very much for attending this webinar, lending your ears and patiently hearing me for the last 1 hour. Thank you very much for the opportunity. It's really been a pleasure. I hope I will be able to, again, sometime, able to interact with you. Thank you very much. Have a very nice day. Bye.